Hello and welcome everyone to another webinar by Smart Karma. I'm Arham and today I have the pleasure of welcoming analyst Syed Desak, who will be taking us through his views on the federal policy expectations and what they mean for the future of ASEAN financial markets. Before we start, a bit of standard housekeeping measures. As always, please feel free to send in your questions for Syed throughout the webinar using the Q&A button located at the bottom of your screen, and we will do our best to get them during the Q&A section. Please do not reshare the contents of this webinar without express permission. A recording will be available afterwards on the registration page and also will be sent to all the attendees. And with that, Syed, thank you so much for being with us today. Maybe you can give us a brief introduction about yourself before we dive right into the topic.
Sure, thank you very much indeed, Arham, and it's a pleasure to be able to convey my views this morning from a nice sunny London today. A bit about myself. I am a US specialist. Given my background, I spent over 26 years working with various US investment banks, spending a lot of time in New York, being based out of London, and I also spent a lot of time out in Asia as well. I kind of gained a big intellectual interest in capital markets in both the US and Asia, as well as economic developments. And I spent a lot of time speaking to people at the Fed in Washington and also regional Federal Reserve banks, as well as spending lots of meeting time at the US Treasury over the years. So I've got to know quite a bit about the US economy, but what's always amazing about the US is that it has an amazing capacity to surprise people, even experienced analysts like myself. And the first thing that I would like to start off with is to say the US economy is a very, very, very complex entity. Underestimate its complexity at your peril, because the capacity of the economy to surprise expectations must not be underestimated. I've got some charts here which I hope will make this clearer as such. If we kick off with the first slide, this is a simple time series chart of the federal funds rate going back to 1955. And as you can see, there's been periods of severe volatility in the past due to inflation pressures, etc. But I think what's really, really telling about the behavior of the federal funds rate over this period is that it does capture some of the structural changes that have gone on in the US economy over that period. In the 50s and the 60s, manufacturing activity had a much greater share of US GDP. And when an economy has a large manufacturing base, there is inherent volatility in GDP growth due to an inventory cycle. And what you've seen through time is that the importance of manufacturing and other goods producing areas in the US economy has fallen, and you've seen significant growth of private services, which tend to be less volatile in terms of underlying activity. And it's had an impact upon Federal Reserve policy, namely through the growth of the financial sector in the US. You've seen significant financialization of the US economy since 1955. That's important. It's important for a very, very simple reason. As the size of the financial sector has gone up, the political clout of the constituents within the financial sector has also increased. Therefore, they're able to lobby politicians more forcefully as such. And so, a classic example of that was during the 1990s. You had Sandy Weill pushing the Clinton administration for the abolition of Glass-Steagall, which he eventually got. So you've got the growth of a sector which has a vested interest in financial innovation and also a structural bias towards lower interest rates as such. I want to give a balance here in terms of how expectations are formed about Fed policy. What you saw after the global financial crisis in 2008, which culminated with the collapse of Lehman Brothers, as such, the Fed quickly introduced a zero-bound policy rate, the federal funds rate, and it introduced the first tranche of a sustained period of quantitative easing. And what happened in U.S. financial markets was quite extraordinary. Essentially, I'll go on to slide 2. What you saw was that bond investors, U.S. bond investors, embraced a secular stagnation thesis about the outlook for the U.S. economy after the financial crisis as such. What do I mean by secular stagnation? It means slow growth, low inflation. That means that the Fed would have to keep monetary policy settings at very accommodative levels for a protracted period of time. And the Fed were not entirely unsympathetic about this view. On slide 2, there's a chart of the FOMC's assessment of the longer-term federal funds rate projection, i.e., what their perception of the nominal Fed funds would be in the long term. It's a kind of proxy for a neutral federal funds rate, and that's gone from 4.3% back in 2012 down to its current 2.6%. So quite a large decline as such. So the Fed shared some of the concerns of bond investors about secular stagnation to the US economy, but it didn't entirely buy the full Monty, so to speak. It was sympathetic to the view. They cut their assessment of the nominal neutral rate, but the idea that policy always had to be super supportive, they didn't quite buy that. And I think you saw the first signs of that back in the summer of 2013 with the infamous taper tantrum. The Fed basically wanted to scale back accommodation. They didn't want to tighten, but the bond market basically disagreed. Yields started going up, and the Fed were basically forced to retreat from their intended goal to reduce the level of monthly purchases of treasuries and mortgage-backed securities. But this kind of secular stagnation as such, it's been embraced by bond investors for a very, very long time. And I think that we could be in the early stages of bond investors actually having a more kind of sober assessment as to what the neutral Fed funds rate should be. Incidentally, I'd like to say that the preferred way to look at the neutral Fed funds rate is to look at it in terms of an inflation-adjusted basis. So if we assume that the FOMC's current assessment is just 2.6%, and the Fed achieve a 2% inflation target, it implies a real neutral rate of plus 0.6%. This is sometimes known as R star. Okay. Now it turns out that this summer, every year, central bankers get together in a place called Jackson Hole in Wyoming to discuss various issues confronting central banks. And it turns out that this year's conference at Jackson Hole is going to be centered around R star and what R star is currently and how it's likely to change moving forward. So what I think is really key here is how are interest rate expectations formulated moving forward. You get all sorts of different proxies for interest rate expectations in the US. You can use SOFR futures. You can use Fed funds futures. My favorite measure of short-term interest rate expectations, which basically are a good proxy of Fed policy conduct, is displayed on slide 3, which is the 2-year Treasury note yield. And as you can see, in the aftermath of the failure of Lehman Brothers in 2008, the Fed introduced very aggressive forward guidance. We're going to keep rates lower for longer. And that succeeded in basically persuading Treasury investors that the Fed funds rate wasn't going to go anywhere anytime soon. So you saw a 2-year note yield hovering just above the Fed funds targets for a protracted period. We saw a brief rally in the run-up to the 2020 election. The arrival of the pandemic forced the Fed into another major policy reversal. Rates were cut back to zero, aggressive quantitative easing reintroduced. Now, the return of inflation has been a bit of a game changer here. And as you can see, the Fed were basically a little bit reluctant to acknowledge the return of inflation. If you recall, Chair Powell was saying that the return of higher prices were basically transient, okay, and the Fed didn't have to panic into an aggressive tightening and reintroduction of positive real interest rates. That diagnosis proved to be incorrect, and the Fed basically had to do a lot of catching up in terms of its credibility in 2022, and that's captured with that sharp rise in 2-year note yields as such. Now, since this particular slide was made, we've seen a slight retreat in 2-year note yields. It looks as though they're currently trading around 475. So they've embraced in recent days greater optimism about the Fed reducing its policy rates over that time period by around 75 basis points. But what's embedded in the 2-year Treasury note is more hawkish than what's currently embedded in secured overnight financing rate futures. They currently expect 2 rate cuts in 2024 and 3 rate cuts in 2025, the last one being quite a big one of 50 basis points to happen in September of next year. These expectations, I'm sure, will change over time. And we must remember one basic thing: Federal Reserve policy is not kind of predestined as such. It's data dependent. Okay, my hunch is that the Fed will seek to lower the nominal federal funds rate this year, but I think it will be heavily dictated by developments with respect to inflationary expectations. The Fed, I know it talks a lot about inflation measures, etc., but the inflation numbers which are produced, they are typically lagging indicators. The Fed will try to look at forward-looking indicators for inflation. They will look at survey-based measures of inflationary expectations for households, but also in financial markets, embedded in the break-even level of TIPS. As such, now TIPS, the break-even level of inflation in TIPS rose modestly this year. It's not they're not disastrously above the 2% target, but if break-even levels of inflation on TIPS roll over, then I think it provides the Fed with a reasonable excuse to basically cut nominal rates in order to keep the real rate of interest unchanged as such. I think in terms of the hard macro numbers, I think the Fed will probably be looking at the labor market data um, very, very closely over the course of the summer. There has been some modest signs of cooling as such. We have an FOMC meeting in a few days time actually. So I expect there to be some minor tweaks to forward guidance. I don't expect the Fed to make a radical change in forward guidance. The thing I think which you have to recognize about the Fed is that they are absolutely loath to make dramatic changes to their economic projections as such, and also interest rate projections. So I think if there's going to be any change of direction in forward guidance, it's probably going to be quite modest and probably going to be quite dovish as well. It's not going to be a case whereby the number of envisaged cuts go from 3 to 5 or anything like that. I think that the Fed will probably try to engineer 1 or 2 cuts this year, and again, the pace and the timing of these cuts will be very much dependent on incoming US economic data. One thing which has come out over the last couple of weeks is that there's a measure of real GDP produced on a live basis by the Federal Reserve Bank of Atlanta. And that was showing very strong above trend growth last month. And the latest couple of readings have actually seen that coming quite sharply. So it looks as though growth in the latter part of Q2 appears to be cooling. Now, so much for the focus on short-term interest rates. The US economy is basically not tied to what happens to short-term interest rates. Long-term interest rates have a massive impact on economic activity, and the Fed cannot totally control the behavior of long-term interest rates as such. If you look at the US economy, essentially, if you've seen a significant change in the origination of credit in the financial system over the years. The banking system is no longer dominant. Okay, capital markets dominate fundraising in the US. They are typically long-dated funding mechanisms as such. So the behavior of long-term rates are more important for the economy vis-a-vis short-term rates. And I would actually like to raise a very interesting observation. A number of people have said that the impact of short-term interest rates on the US economy has actually been diluted because of this credit intermediation towards the capital markets. But there's also another thing which I'd like to point out. If you recall, when COVID came along, the Fed basically opened up borrowing facilities as such, and US corporates had an opportunity to raise a lot of cash very, very cheaply as such, and they did that. Corporate liquidity is very, very high. And what you've seen is that cash-rich companies have actually been able to lend out surplus cash to money market funds and basically earn decent returns on that surplus cash. So in a way, higher short-term rates haven't really impacted the corporate sector that much. Furthermore, if you look at the household sector, believe it or not, the household sector is a owner of net assets in the realm of interest earning instruments. So households, they hold a lot of savings and time deposits at banks. They hold a lot of short-dated treasury securities as such. Now, these numbers are absolutely huge, okay? And they also hold, by the way, a high level of money market funds. So financial assets that are tied to short-term interest rates significantly dwarf the liabilities that are tied to short-term interest rates. So in a way, higher short-term rates, courtesy of the Fed tightening, has been a bullish development for household balance sheets. And that probably helps to explain why measures of debt stress and so forth for households have remained remarkably benign despite the sharp rise in the federal funds rate. Now, talking about potential spillovers into the world economy as such, essentially the Fed is cognizant of the role of the dollar as a trading currency, as a reserve currency, and they have been more than happy on previous occasions to help to satiate any supply shortages of dollars whenever they've arisen. And I think from an international funding perspective, I think the chances of there being really significant dollar shortages around the world have been reduced by the Fed through dollar liquidity swaps, but also there was the big game changer during COVID, and that's for a foreign bank as such. What the Fed did normally, if a foreign bank wants to tap the Fed's discount window, that foreign bank must have some kind of US-based subsidiary. As such, the Fed changed the rules there during the pandemic, and that's even if a foreign bank didn't have a US-based subsidiary, they were basically more than welcome to tap dollar funding via the discount window. So the Fed, if they were ever confronted with a dollar shortfall outside of the US, I think would be more than pleased to satiate the demand for dollars. Now, what you've seen in the US, okay, you've seen a significant reluctance of long-term interest rates to basically rise significantly over the years, despite pressing budget deficits, periodic concerns about the Fed's anti-inflation credibility. What you've seen in the US has been that the term premium demanded on US Treasuries has generally been declining since the early 1990s. This is important. The term premium is important. Long-term interest rates show market expectations of the future path of short-term interest rates, and normally short-term interest rates are more volatile than long-term interest rates. The Fed's policy conduct after the financial crisis basically suppressed short-term volatility, short-term interest rate volatility significantly for a protracted period. And what basically you've seen is that financial accommodation has increased significantly since the global financial crisis via a declining term premium as such. A declining term premium will increase the amount of financial accommodation for any given level of short-term interest rates. And going into COVID, and basically you had investors demanding a negative term premium as such, which was consistent with very buoyant US financial accommodation. We've seen the term premium basically increase over the last year as such, but it remains in very low territory. Measures of US financial conditions as such suggest actually policy, the policy conduct of the Fed hasn't had a major impact on aggregate US financial conditions. I think it's partly due to the fact that the term premium has actually remained very low. But there are international consequences for this because basically a low term premium on treasuries will mean that there are spillovers into the corporate bond market in both the US and overseas. So corporate borrowers who basically want to borrow in dollars, okay, will enjoy lower funding costs as such. Now, I want to talk about US monetary policy and what it means for the ASEAN region now. And what I thought was a good starting point was looking at the correlation between US Treasury note yields and the MSCI ASEAN index as such. And what you can see from this correlation is it's very volatile, and during a lot of the period since 1996 up until now, the correlation has been positive. Now, this sounds counterintuitive because the story has always been that if the Fed eases, okay, short-term rates go down, long-term rates go down. That should be bullish for emerging markets as such. And what you've seen from the objective data is quite interesting. Remember, the Asia was confronted with three very, very serious deflationary shocks in the course of 10 years. It started off with the Asian financial crisis in the late 1990s. It was prolonged by the bursting of the internet bubble in 2000. And then you had the global financial crisis, which also imparted significant deflationary pressures around the world. And so I'm not surprised that you've seen such a prolonged period of positive correlation between the 10-year Treasury note yield and ASEAN equities. And whenever you get a sustained period of positive correlation between bond yields and equity prices, it normally signifies the prevalence of quite severe deflationary psychology amongst investors. You saw it in Japan. You saw it in the US as well, where basically equity prices and government bond yields became positively correlated. It's a condition known as Gibson's paradox as such. But given the volatility in the correlation, this suggests to me that deflation can explain some of the movement in ASEAN equities, but not all of it. Okay, there are particular factors at play in individual markets. Let's look at what's happened in terms of ASEAN equities. Right, I spoke about deflationary shocks just now. Okay, basically, you had a massive shock to the ASEAN economies and financial systems in the late 1990s. I remember it well. I was in Hong Kong when things started unraveling very badly, and markets gradually recovered started recovering in 2020 in 2003. Okay, and then the global financial crisis came along, and another hit to the region was imparted as such. The response of global central banks helped to produce a sharp recovery, but essentially what you've got here is a sideways to maybe slight downtrend in terms of underlying movement as such. Now, I think the disappointing performance of ASEAN equities since 2014 as such reflects a number of things. One, if you look at the composition of benchmark indices in the ASEAN area, with the exception of Thailand, financials have a very, very heavy representation, and essentially, when you've got low inflation, as such, low policy rates, it's not great for the profitability of the banking system as such. And I think that's part of the disappointing performance of ASEAN equities over this period reflects issues with the profitability of the banking system. Now, with every cloud there comes a silver lining. The arrival of higher for longer in the US has probably been positive for some banks in the ASEAN region this year. I noticed that Singaporean banks have done pretty well this year as such, and that's partly, I suspect, due to the fact that the Fed is keeping policy higher for longer as such. Now, the ASEAN underperformance has been particularly profound since 2014. If we look at the Dow Jones ASEAN Titans 100 index as such, with the ASEAN Titans, basically Singapore is excluded. Singapore is included in the MSCI index. Vietnam is included in the Dow Jones ASEAN index. If you look up the ASEAN Titans compared to the S&P 500, I mean, it's basically been a tough slog. It's been a tough slog. I think here you've got a number of forces at play. Let's look at the easy ones to explain it away. First of all, the dollar has been strong over this period against emerging markets. If you look at the trade-weighted dollar index of vis-a-vis emerging market economies, that has appreciated over 30% since the end of 2013. So a strong dollar hasn't helped. What basically you've seen has been U.S. equities become the only game in town, so to speak. The Fed, the Fed has not been tight. It's been, I think, generally accommodated over that period. What I think has been the big differentiating factor between the ASEAN area and the US has been this very, very disciplined approach to maintaining profitability, particularly since the global financial crisis. US corporations remain fixated with keeping very, very high operating margins as such. And what you've seen is that capital has gravitated to an economy with highly profitable firms that, as such. If you look at capital flows as such, the US since 2017 until the end of last year, US institutional investors were net buyers of foreign equities to the tune of around $1 trillion as such. So they have invested outside of the US. But what's interesting is that the bulk of the money has tended to go to Europe as well as Latin America. Asia Pacific has actually not performed that well in terms of being a favored destination for US investors at this point in time. And I think what is needed there is some kind of structural story there that will entice investors to basically put money into Asian equities and basically keep that money in Asian equities. That is something which is beyond the control of the Fed and not the Fed's responsibility. As such, I think it's potentially a very exciting story to be told about the ASEAN economies moving forward. But this outperformance that you've seen here in between the S&P 500 and the ASEAN Titans index helps to account for a dramatic widening in the valuations that you've seen between US equities and ASEAN countries, as well as the rest of the world. I mean, typically, US equities tend to trade at a premium valuation compared to other markets as such. Now, I checked yesterday, and the MSCI US index is trading at a 66% premium to the MSCI Emerging Markets Index on a 12-month PE basis, and that's elevated as such. I mean, the US equities are basically priced to perfection as such. That there is downside risk if earnings don't come through. There's also downside risk if heaven forbid the Fed makes a policy mistake. In terms of the valuations for the ASEAN region, I think to rely on the Fed for help to enhance valuations, I think that's not the way forward. I think for good local currency returns in equities and bonds in the region, I think you need to see central banks in the region cutting rates. Central banks in the ASEAN region are not in a big hurry to cut rates aggressively ahead of getting better information out of the Fed. I'm sure that they'll be closely following developments at the next FOMC meeting as such. So I think that the outlook for ASEAN markets is it's a steady as she goes scenario as such. The macro backdrop is it's actually not bad. You've got some decent domestic demand forces at play, particularly personal consumption. You've also got the reopening of economies and tourist arrivals have gone up, etc. There is concern, obviously, about the indifferent momentum about export growth, and I think that that reflects a more intense market out there as such. ASEAN economies are competing head to head with China and also with Japan for market share, particularly in the US. So competition is tough as such. I do think that there is a potential supply side bull case for the ASEAN region. What you've seen, okay, the developed world is stepping back from China. Okay, they want their supply chains to be less dependent on China. That means setting up supply chains in other parts of the world. So ASEAN countries are likely to be beneficiaries of that as such, but it creates an incentive for ASEAN firms to basically become more profitable. When you get foreign direct investment coming into an economy, it's very unusual for the foreign companies to basically not have business procurement arrangements with local firms as such. Local firms will have to tender for doing business with the foreign direct investor, and so they have to be price competitive. And what I think the arrival of FDI into the region will do, it will focus firms to be price competitive and also to focus upon enhancing internal efficiencies via productivity growth. So that is bullish in terms of making market valuations richer as such. So I think that the outlook for the ASEAN region as such, it's going to be partly determined in terms of the timing of rallies it will be partly determined by the Fed essentially saying, okay, we're going to cut rates now, and this is our likely path for the federal funds rate. And moreover, it will depend upon the confidence of local central banks to basically feel comfortable with lowering rates as such. I think that the central banks that could feel comfortable about maybe being a bit more aggressive, those central banks will have to basically monitor inflationary expectations as such. The region as a whole, I think, has become less of a hostage to sudden withdrawals of foreign capital as such compared to the late 1990s. The region is running a current account surplus in contrast to deficits of the late 1990s. So I don't think that central banks have to fear no, massive withdrawals of foreign capital just like that. But I think they will be very careful not to ease too prematurely or too aggressively as such moving forward. So that basically concludes the kind of formal part of the presentation. I'm happy to take questions. If you want to ask questions on the ASEAN or the US together, I'm happy to do that. So without further ado, thank you.
Mention to all of our participants, you can now send in your questions for our speaker using the Q&A button on your Zoom app. Perhaps I can start with the Q&A session with a question from our team. And you briefly did touch on this during your presentation as well. But in your opinion, do you feel that markets are still addicted to easy money? And what are the implications of this?
The short answer to your question is yes, they are addicted to easy money because if easy money is associated with low short-term borrowing rates, it means that access to leverage becomes very easy, and whether you like it or not, leverage has become very fashionable over time. I think how could I put it? I mean, markets have become used to being able to bully central banks to ease policy. Okay, the U.S. Treasury market did it a couple of times after the global financial crisis to the Fed. Arguably, the Fed should have been able to have proceeded with tapering in the summer of 2013, but they were pushed back by markets as such, because what markets threatened to do was inadvertently tighten financial conditions by selling off credit markets. That is so. No, I do think that markets have been able to bully central banks over the years to basically keeping policy too loose for too long.
Great. And you mentioned as well that how the rallies will be partly determined by the US monetary policy, but do you believe that the ASEAN markets can rally without the help of the easy US monetary policy?
Well, I mean, I think ultimately, if you look at the US, why have US equities done so well? Okay, since the global financial crisis, is because the corporate sector has actually performed very well. Profits have risen significantly. They've outpaced the performance of the rest of the economy, of the aggregate economy as such. And ultimately, equity investors will choose markets where profits are basically growing impressively and in excess of the rate of inflation. So I think if ASEAN markets want to enjoy significant and sustained rallies, what the corporate sector needs to do is to basically engineer changes in operating procedures that ultimately result in higher returns on equity and higher returns on capital. And if they can demonstrate strategies being implemented that enhance shareholder value, then the chances of capital coming into these markets and actually staying there are significantly enhanced.
Great. Thank you so much, Syed, for answering these two questions. Unfortunately, in the sake of time, these are all the questions that we can take today. Maybe you can share with us some final words that you would like to leave our audience with about today's topic.
Yes, I think the baseline scenario is that the Fed, I think, has stopped raising rates. It will lower rates when it feels comfortable, depending on incoming economic data as such. And I think that the threat of funding issues, dollar funding issues in the region, I think that's they are past their worst as such, and that dollar funding issue should not be an issue in the ASEAN region. And it is down to the timing of local central banks to feel comfortable with cutting their own policy rates as such.
Thank you so much, Syed. We do have one question that just came in. Would you like
Sure.
to address it? Yeah. So the question is from an anonymous attendee. Do you have the time horizon? When will the Philippines stock market index be bullish?
Right.
Specific. Yeah.
Yeah. Well, I think for the Philippines, the fundamental problem with the Philippines is that I think that it has a more serious inflation problem to deal with, and that's if you want to be structurally bullish about an economy and you want to and you're prepared to pay higher PE multiples for that market, ultimately I think you need to get inflation lower, and that's going to be a test of the central bank's credibility function moving forward. So I think that's essentially the Philippines needs to get on top of inflation first before I think I would feel comfortable with my own money taking a longer term position in that particular market.
Great. Thank you so much, Syed. And that's our webinar for today. Thank you so much for your time today, Syed, and also everyone for attending. If you wish to keep a track of Syed's work, I recommend following their profile on Smart Karma so you never miss any of his insights. I've also shared the link to his profile in the chat box. Please do note that Syed is also available for bespoke research requests or premium services. So if you wish to engage him for any of those, please feel free to contact your Smart Karma account manager. If you do have any unanswered questions, you can email them to us at research@smartkarma.com or even leave them as comments under the Insight registration page. Thank you very much, Syed, and everyone for today. Once again, goodbye.
Thank you.
Thanks.